And so today we're going to talk about institutional order flow. We're going to talk about institutional order flow, which is simply abbreviated IOF. Okay, institutional order flow. Now, this is simply the study of where price is going, where price is coming from, right? Where are the institutions pushing price to? Where is the order flow? Which is it a market bearish or is it bullish? Now, this is one of the key elements when it comes to technical analysis based on those who trade smart money or ICT and all that, all right? You primarily need to understand where the market wants to go to so that you know whether you're going to position yourself in a bearish structural market or in a bullish market, right? Basically, let's say, for example, that you identify that the market, the institutional order flow is bearish, which means price is seeking, the market is seeking lower prices. Therefore, based on the market structure lessons that we have had already, you would want to position yourself in a bearish structure type, right? You would want to position yourself in a bearish structure side, and also you know that even though the institutional order flow is bearish, the market will always want to have both participants in the market. This literally means that biggest volume of the market is going to be selling, but then it needs buyers active. And you know that buyers are going to be placing buy stops above highs like this. You know about breakout traders, and even those who are selling, they're going to be placing their stop losses above those highs. And if you're a seller and your stop loss is above this high, it simply means you are placing a buy order to buy what you sold here, but now at a higher price. That's why if price hits your stop loss, you're ending up with a loss. But there are others who are placing completely buy stop, saying that if the market breaks this high, then it's shooting up. So they don't want to miss the move. Now, so you now want to position yourself around these liquidity areas or around where buyers would want to come in so that you can be able to sell to them, right? That's just the simple logic. So if you actually know that, all right, if I want to buy, then I need to buy from those who are selling, okay? Because people are placing sell stops here. You need to buy from those people. Now, it is very normal. This is just the basics of it. And I think everybody's trading this way now, like waiting for price to take a high, waiting for price to take a low before they buy and all that. So everybody now know about stock bonds. But the thing here is they don't really understand the logic behind it. But then it is just very simple because sometimes you'll feel like, okay, price is bearish. So if we take this high, then we should go lower. But then price will take like that, then still go up, still come down, and at the end of the day, you get all mixed up because maybe you are pattern trading, you did not understand the logic behind it. Now, institutional order flow here helps us to determine where price is going. Okay, when you determine where that price is going, which is solely on the higher time frame, take note of that. You determine your IOF on the higher time frame, okay, which is from the daily, we have weekly, we have monthly, and we have quarterly and all that. Okay, these are the time frames that you determine your order flow at. You don't go, I will not advise you to go below the daily. Why? Let me tell you something, or let me quickly illustrate why these higher time frames actually are important for you to use them as to determine your IUF, right? Now, let's look at the structure here. There is this structure. We have price move like this, and then it breaks the structure, okay? And then it comes back. Maybe we test whatever here, fair value gap or optimal entry or other block. And then we have the same thing here. Price does the same thing, okay? Breaks the structure, comes back for whatever, fair value gap or other block, and then it pushes higher. Now, this is the higher time frame. This is the higher time frame, and then this is the lower time frame. Now, let me tell you what is happening here. This push, because this is what we are going to be more interested in, okay? We are interested in this push. We are interested in this push. Now, what happens is that this push on the lower time frame might take you just about 2 hours. It might even take you about 30 minutes, right? But here, this push here is going to take you about 3 days, sometimes 1 week, sometimes 2 weeks. Maybe even if it's taking you a whole day, that's going to be 24 hours, right? Which means that you have a complete day to be bullish. But here you have just few minutes to be bullish. So this is why when you determine your higher time, your IUF based on the higher time frame, which is what I'm going to be teaching you in this lesson. You prefer to use higher time frames because let's say, for example, that from here, okay, let's say at this point, price comes down to this other block here. Let's say we had that breakout structure, then price comes down to this other block. Now, how many candles do you think now will push up to this high? We might have 5 candles, 3 candles, 1 candle. Like, for example, this might be 1, 2, 3 candles. And this might be the same here, 1, 2, 3 candles. But now, the difference is that this candle, this might be 5-minute candles. This might be 15-minute candles, which means we have just 3 15-minute candles. But look at this one. This is 3 days, 3 straight days, or maybe 3 weeks. If this is a weekly candle, then we're having 3 weeks. If these are quarterly candles, it means we have about we have how many? We have 4 quarters in a year. So it simply means that we have a whole, maybe almost a year for price to just be bullish. So this means that if today was bullish, we're expecting tomorrow to be bullish again and after tomorrow, and then you already have buyers for tomorrow and after for tomorrow. So all these 3 days you are likely bullish means you are just trying to buy. But here, after you cannot tell me that after 5 minutes you're planning to be bullish the next 15 minutes, and so this does not sit well. I mean, that patience or that level. I mean, trying to be. I mean, it's based on scalping, but then it's too much of a short period of time, right, to actually make good decisions. But with this one, today you are bullish, and this today alone might give you a clear structure like this. Then tomorrow again gives you another clear structure like this. Then after the next day gives you another clear structure. You'll be able to know how to align yourself here in this uptrend rather than here. All right, because each day here is about 24 1-hour candles and stuff like that. So we have so many candles that will give us this uptrend structure that we're looking at. So this is why I say determining national order flow is solely based on higher time frames starting of the weekly, because it gives you room to know actually to be able to plan your whole day, right? It will give you all that time to be able to. Now let's go straight up to the daily chart. Let me just quickly show you an example from now before we move forward. Okay, this is the daily candle. I mean, this is the daily chart. Now, as from somewhere, let's say price was actually pushing up. Let's just use this high. Okay, and then we know that okay, this was another block, so therefore price was about to take this high, which was like an inducement high. Okay, so and let's start from somewhere here. Let's start from somewhere around this point. Let's start from somewhere here. Okay. Now, when you look at this price action here, you notice that the market is completely bullish, and with the knowledge of other blocks, which I think we're still going to have a lesson of it. This last bearish candle or this down close candle is actually acting like a support to price, right? So it's supporting price, which means the moment price hits this key level, we're expecting more bullish prices. But now, come to think of it, what if this was the 15-minute time frame? This can be just about 1 hour price will hit this level. But now this is the daily time frame, which means that we don't even yet know how many candles will take us to reach this drawn liquidity where we have the thick line. But then we will now start to position ourselves to be bullish, all right? Because we know that price is rejecting, or we are having a key level. So as of this point, you can say that your IUF is bullish because for this number of days, we're going to be expecting higher prices. Not saying that some of these days will not be bearish. Okay? Sometimes you might have a bearish candle within that push, but overall, we know that price is interested in higher prices. So which means that within this day, all we want to do is look for reasons on the lower time frame to expect bullish scenarios. Okay. Now, for example, here we have price now closing above this downward candle. Same scenario here. So this candle is also going to become like another support, right? So which means we expect price to bounce off from here and then continue higher. So we already have a key level plus. We had a volume gap here, which is a very interesting level as well. Now, whatever we are doing on the lower time frame, we know that prices are bullish. And sometimes, normally on the lower time frame, you're going to see a structure like this, right? Maybe just from here to this point, we were bullish, and then we had this bearish candle, which was around here. Okay, so this was supposed to be this support. And then for price to come back down to it like that, is going to shift structure to the downside. Now, if you have no clue on the higher time frame IOF, you're going to totally start to become bearish. All right, because just for the fact that price push lower, take it passing through prior daily lows, it's already going to be showing us a downtrend on the lower time frame. So this simply means that if you have no idea about where the daily is going or where the higher time frame is going, you would expect prices to keep going down, right? But that's not the case. You know where the higher time frame is going, and you have a key zone, all right? You have a key level where you expect price to bounce off from. There's also this volume gap. So the moment price pulls back to this point, what are we expecting? We want to see a shift above. Now, when we see this shift above, we are not going to think that this shift is a stop point, okay? Because that's another mistake now that people are making. They're going to see this shift and think that is a stop point for prices to do what? To continue down, but neglecting the overall IOF direction, neglecting the overall higher time frame bias. So you feel like, okay, yeah, stop points, key level. The fact is that you might actually have a very nice order block here, but then price will do something like this. Come down to the original order block and then shoot up. Okay? Maybe it will give you just this little movement here. I have told you previous lessons that the price is very patient. Sometimes it makes you feel like, yeah, you're in the right trade, but at the end of the day, maybe as you're trying to pile in more positions, you end up hitting stop loss. All right, so you have to understand this very well. IUF is determined on the higher time frame, and it's not something really complicated. Now, you're going to ask yourself, how do we determine this IUF now on the higher time? How do we determine IUF on the higher time frame? Now, there are practically couple of elements where I personally use, and the first one is candle closures. Okay, we have candle closures, and we have market structure. We have market structure, and what again? We have candle closures, which is very important, and we also have market structure, which is also important. All right, now under this under market structure, we have key levels. On the market structure, we have key levels, Okay, we have key levels, which is we have your other blocks, you have your fair value gaps. You might also have liquidity purchase on the daily time frame as well, right? Structure is the same in all time frames. So if you look at this area, you're still going to notice that there will be zones where price would have to stop hunt a low to still keep moving higher. Okay, so it still happens even on the higher time frames. So when we are talking about structure, we're still looking at this is still very possible to happen on the higher time frames and key levels, like I said, other blocks. Okay, and now your most important thing when it actually comes to institutional order flow is the draw on liquidity. And this draw on liquidity leads us to the main thing, which is what? Liquidity. And under this liquidity, we'll be talking about internal liquidity and external liquidity. And then there is this common saying that I used to write that the market, okay, the market moves from internal range liquidity to external range liquidity and vice versa. All right, so which means that, and then under this is going to be probably our next lesson. We have internal range liquidity here. In this case, internal range liquidity here is our order block here and even the fair value gap. All right, because now the external range liquidity is simply highs like this. Okay, when the market grabs a high, it comes back for internal. When it grabs a high, it comes back for internal. In this case, this internal here was the volume gap plus the order block. External range liquidity is simply just swing highs and swing lows. But when it comes to internal range liquidity, we have order blocks, fair value gap, volume gaps, and all those things. Why are they internal? Because they are found within a swing high and a swing low. All right, so this is primarily what I use. Okay, the logic I use to be able to know whether, okay, if I'm using candle closures, where is this candle closure important? Is it important for me at an internal range liquidity or external range liquidity? Okay, because for example, let's say for example, price stop owns a high like what we have here. Okay, let's say for example, let's just look at this area here, and then let's just look at this point. Okay, let's just look at this area. Now we notice that there was a high here. Okay, there was a high here, and there was another key level here. Okay, order block. Now price stop owns this high, this one we have here, and also stop owns this one here. Now, when we talk about candle closure here, okay, when we talk about candle closure, look at the candle close. Look at this bearish candle. Look at this bearish candle. This already tells you a shift in this delivery, okay? It also already gives you a clue that price is likely to want to drop lower. That's a bearish engulfing, and it's happening based on the key level. And take note, it is happening on the daily time frame. Now, this does not just mean that price for the next days must be bearish. No. Sometimes the market with this a bearish engulfing, maybe we have some key levels on the 1 hour that have been formed within that particular day. All right, maybe we would have had some bearish fair value gaps or stuff like that, and the market gently pulls back into it, and then it continues down. Now, after that, when price pull back, retesting this other block, look at candle closure again here. We have this bearish candle again, closing below this one, and that was another sign for more bearish moves. And now we have a low here. Looking at the close of this one, looking at the close of this candle, you already know that this one is likely going to be bearish as well. Okay, so what I'm simply trying to make you understand is that when you are determining your institutional order flow, market structure here deals with key levels, just like what we have here. So this means that you can know that, okay, this was a key level and this was an inducement to that key level, and its price will go there and then come back like this. Now, this took you how many days? It took you a couple of days. So at this point, you have a bias for like a week and a half. expecting lower prices. Okay, but if this was a lower time frame, this will just happen within a twinkle of an eye, and that's it. That's the end of the story. But for this, when you're using the higher time frame to determine where price wants to go, it gives you room to have a bias maybe for a whole week. It can give you now reasons to maybe hold this trade from maybe that 1 hour key level, and then you hold it right down to this point, and that will give you a lot of pips. Okay, that will give you a lot of pips. Now, I use market structure, okay? Market structure when I'm dealing with Schneider flow, all right? And I also deal with candle closures. I've already mentioned about candle closures, seeing the close of this bearish candle after hitting a key level, okay? Look at this one again. After retesting the other block, you see the way this one closed. This one went back up, retested this other block again, and then see how this candle closed, and then this one as well. So candle closures is also very important when determining when next price or where price wants to determines. I mean, it helps you to know how to plan for tomorrow. Your daily bias, right? When you're identifying daily bias is very important. But now let's look at this. Let's look at this one. Actually, before price came up to take this high, which we knew that it was an inducement high, look at what happened. Look at this heavy bullish candle. Now, seeing a bullish candle like this doesn't just mean that tomorrow you start jumping in for a buy. You have to be very careful and you position yourself, like I just told you earlier, that this bullish day is going to have something like this, okay, on the 1 hour time frame. Now, you know that for the market to push higher, it needs sellers as well, right? So these previous days, or maybe these, now you will also notice that we had a bullish order block here. So which means the bullish order block is somewhere around this area. The bullish order block is somewhere here. Now the following day open, traded a little bit down. The next day open, traded down, taking out all this liquidity. And then finally continue to the direction where we have the draw on liquidity. Now, if you have no idea where price was heading to, it will be difficult for you to know that this breakout structure, it doesn't mean that price will continue down. Maybe you start looking for your other block and start plotting some inducement and expecting price to go lower. Okay, so this is very important. This is very important. Now, let's look at internal range liquidity to external range liquidity. When you identify a structure on a higher time, you know that the market is bullish, right? Now, man, this topic just has a lot to say. Okay, it has a lot, but everything is just trying to revolve around time frames and candles. Okay, now if you might be looking at this area and now you like, okay, my coach, what is this? This is why should we be selling here? Don't you think price is now bullish? Man, but if maybe we go to a more higher time frame, you will see that this is what is happening. It was just maybe a pullback, stuff like that. Maybe if we don't go to a more higher time frame, like 3 months, at the end of the day, it's just like, look at what 3 months did now. 3 months was actually pushing higher, right? We took out this high just from what I was explaining. External, we coming back for internal. Okay. We had a bearish engulfing. Likelihood that the next 3 months candle might be bearish. We don't know. Maybe it might want to come right back down to fill up this internal range liquidity here. Okay, which is this fair value gap, and using also this low as using this low probably as an inducement based on having this candle here. Okay, but at this point, this is a whole 3 months movement. But when we are on the daily, we just see it to look like price was in a downtrend and now is on an uptrend. So this is why it's very important. You're looking at the quarterly, you're looking at your monthly, even if you want to look the 2 months, checking all that so that you'll be sure at which phase you're currently, because If you were not, if you did not look at the monthly time frame to know that you have an order block here, to know that you have an order block here, okay, you will not be very sure that this is a good zone to start selling from. Okay, you will not be sure that this is a very good zone to start selling from, and maybe you would have been asking yourself, okay, why did we not sell from here? Why did price not respect this bearish order block here, and stuff like that? You now understand that this was because of a bigger picture than the daily. All right. So you always want to have that higher time frame direction. You always want to have that higher time frame clue that, okay, this is what is likely going to happen based on the higher time frame. About 2021, like that, I did some analysis on the DXY on the six months time frame, on the 6 months time frame. And I think I cannot remember very well. And it took about 3 years. So when I still go back to my Facebook page, I see that I posted it there, and it still played out. I actually forgot about it already. That was because I wasn't a position trader or a swing trader, rather. Okay, so it will not really help me that much to go too far into those high time frames. But now let's look at something here. This is the yearly time frame. Okay, this was internal range liquidity. We have all this inefficiency here. We have all these inefficiency gaps here. Now, we see the yearly time frame fill the gap like this one, okay, and then started printing us a bullish engulfing here. Remember, this is the yearly time frame. We're having a bullish engulfing on the yearly time frame. So within this period, within these 4 straight bullish years coming to grab internal range liquidity, 3 months of it, this is the three months time frame. If we are going down to maybe like weekly, let's look at it on the weekly. Now, this is about how many years? Remember, it's 4 years, it was about 3 years, right? Now, this is how the weekly looks like. We are overall bullish, heading somewhere, which is internal range liquidity, even derived more clearer on the 12 month time frame. But when you're looking at the weekly, you might not necessarily know why this high is very important. But when you look at this on the yearly, the high is very important. Okay, maybe on the weekly, you might limit your bias just to this high because it's very obvious on the weekly. But then when you're looking at the high time frames, you will notice that there is something more interesting right up to this point. Okay, and it will help you to know that price is heading somewhere. But regardless, you have to still put yourself in the time frame that you're currently at. You don't just expect price to just push straight up to that higher time frame. No. And based on market structure, you can see that we have this nice order block here. And this is what the weekly did. It came right back down, took out this low just to respect this order block to then continue higher. This is the same structure you're going to see on all time frames, even on the 1 minute. All right, but this doesn't change the fact that price is coming up to this point. This might have even taken about 5 months or 4 months and stuff like that. But now, where is it reacting to? If we look closely, we're going to notice that this reaction was as a result of price taking out buy side liquidity from this high. Okay, was as a result of price taking out buy side liquidity from this high, and price had to now return for internal range liquidity, and in this case, taking out this swing low to react to this order block. Now, if you were not really sure about price respecting this order block, you would also want to wait for confirmation, and that's candle closures now, price closing above this bearish candle that tap into that zone will give you all the confirmation that you need. And if you're now a position trader, you already know that what sellers have been activated. There are sellers who are placing sell stops here. There were also those who were trying to buy this zone. All right, their stop losses have been activated, and there are now selling. There are sellers. The selling part of the market now is active. So if we're buying now here or buying from this point, We know that we have sellers in the market. Okay, we know that we have sellers in the market. Now, this is a very interesting pattern, and you can see this pattern on all time frames. Price taking out an inducement low into another block, which broke structure and then targeting a key level. If you're not very sure about its reaction, you wait for a shift in market structure based on this model one entry or other block formation, and then price continues higher. In this case, even if you're not sure, you can use the line chart and it will still give you, you will still see that break of structure right there. Okay, so what I think we're going to have another class just solely on this issue of the flu, because I feel like this is just like maybe like an introduction with not very direct examples. But I want you to understand this. The market moves from what? Internal range liquidity to external. When it grabs external, just like it did here, it comes back for internal. And sometimes this internal is, sometimes you have, let's say, for example, the market is heading higher, okay? It breaks a high and then it comes back. Now, maybe we had something like this, price breaks this high, and then it's coming back for internal range liquidity. Most of the time, you'll feel like, okay, your internal range liquidity is this other block here. All right, you also have to check based on liquidity, the logic about the market delivery. Most of the time now, what will happen is that the market will come, maybe we will not respect this other block, trade lower to respect the one below this swing low, and then continue higher. So what was the internal range liquidity here? Probably the other block here, all right? Not this one that was formed within the swing move. And is exactly what we have here. Okay, so when we are talking about prices moving from internal to external, you have to be very careful, especially when it comes to internal, so that you don't position yourself in an area where the market will use you as the liquidity to move higher. Because if you could have placed your buy order here, your stop loss here is going to be a sell order, right? It means you bought something higher and you're selling it cheaper. So the institutions will want to push price so that you sell out what you're buying, and then they'll be able now to buy from you at a much cheaper price. Okay, so things to note from this video is your IOF is equal to market, your IOF is equal to what? Higher time frames. Okay, you choose that you study market structure on the higher time frame, you study your key zones on the higher time frame. If you have just a nice order block on the higher time frame, if price just wants to come to that order block and give you one bullish candle, that is enough for you to make good money from it, right? It's enough for you to make good money from it. Now, so you determine your IOF based on higher time frames. Now, the next thing that comes up to you have to start asking yourself is internal. Know that the market moves from internal. The market moves from internal to external and also moves from external back to internal. So when the market breaks a high, it has to come back for internal. And this internal might not just be a very clean fair value gap. Sometimes the internal might be a swing low that will act as inducement to now that real internal range liquidity here, okay, before it moves higher. So the market will move, once it grabs this external, it is now going to come back for internal. Sometimes you come, your internal will be here, and then you will generate liquidity ahead of that internal before taking the liquidity now and then tapping into your internal range liquidity. So you always have to also consider that inducement when price is coming back for internal range liquidity. Now, when you trade that internal back to external, once price grabs the external, you are out, and then you are waiting to see the next thing that the market does when it's coming back for internal. All right, so I think that I've talked a lot already, and we should have another class on this. Now, I'm going to allow you to unmute yourself so that you can ask questions, and I will clarify you.